Hi everyone, thanks a lot for joining me for this week's Forex Education Hour. I'm James Harte from littlefishfx.com. In today's session, we're going to be talking about what is perhaps one of the simplest yet most effective elements of technical trading, and that is support and resistance. Now, support and resistance are often overlooked by a lot of people and discarded as simply being random lines drawn on a chart where we hope to see a reaction from price. But to think of support and resistance in these terms only is to totally misunderstand what support and resistance really are and the opportunities they can afford us in the market. So in this session, I'm going to explain to you the underlying order flow dynamic that creates support and resistance. I'm going to talk about how you can properly identify support and resistance levels in the markets. And we're going to look at the ways that you can incorporate support and resistance levels into your trading. Now, as ever, please feel free to drop any questions you have during the session into the chat box, and I'll stop periodically to answer them as we go along. Let me just share my screen and we can get going. Okay, so first of all, what is support and resistance? Support and resistance levels that we highlight in the market actually give us some insight into the underlying order flow present in the market. Support levels tell us where there has been demand in the market in the past and where we can anticipate that demand remains. And resistance tells us where there has been supply in the market and where we can anticipate that supply remains. And really, that's all this boils down to, a game of supply and demand, with price driven by underlying orders. Support and resistance levels identify areas where we can potentially get involved, looking to buy price where there is good demand and looking to sell price where there is good supply. So let's look at some examples of this and talk through. Okay, so here we can see we have resistance overhead. Resistance is where there is a buildup of orders to sell, which we call supply, and whereby we can look to profit from the likelihood that price will react lower from this area. Then beneath we have support. This is where there is a buildup of orders to buy, which we call demand, and where we can look to profit from a likely reaction higher from this area. So you can see that when we think about support and resistance in these terms, they aren't just lines drawn on a chart with no meaning. They're actually giving us a glimpse into the order flow that is driving the market. So looking at this example and thinking in those terms, we can see that initially price was moving sharply to the upside. We had this long extended run with hardly any bearish candles, showing us that demand was strong. But then all of a sudden, we can see there is a total shift in the market and price reverses sharply. So we know that from this point here, there were more sellers in the market than there were buyers. Buyers had been in control for the whole of this move up, and then all of a sudden the supply-demand scale was tipped and supply took price back down. So we know two things at this point. We know that there was a lot of demand down here initiating this move up, and then we know that there was a lot of supply up here to reverse the move. You can see then that as price sells off from that high point and trades lower, we move right back down to almost the very start of this bullish move. But then you can see that price stalls out and actually reverses higher. So price is actually confirming the demand that we suspect is in the market at this level. So now we have our resistance level to watch overhead, where we got this sharp reversal lower and where we anticipate there is strong supply. And we also have a support level to watch, where we anticipate that there is strong demand as we saw price turned sharply higher. So now from this point, we can see that price trades higher again as buyers are once again in control. And look where we head. We head right back up into a test of that overhead resistance, where once again, supply overwhelms demand and price is taken lower once more. You can see that between this point here and this point here, all that is happening is the supply-demand scale is being tipped shifting between stronger demand to the bottom of the range, which takes price higher, and stronger supply at the top of the range, which takes price lower. So once we bounce once again from the support level, we trade all the way back up, we retest that overhead resistance level, and you can see that we sell off again as supply overtakes demand, and we nosedive right back down into that support zone, where just like we saw previously, demand remains in the market stronger than supply is at this point, and we can see that price reverses higher. So what we're seeing here, what this example demonstrates, is a battle between buyers at this level and sellers at this level, each trying to break the other side to take price in their desired direction. Now, as these levels start to make themselves known, we then see speculative players joining in, and they reinforce this dynamic. We see traders selling as price trades into resistance because they anticipate that the strong supply is going to be enough to take price lower again. And then we see traders jumping into buy positions as price tests support, anticipating that demand is strong enough to take price higher. And think about it. If you're trading in this area, and let's say that you're short from up here, where is going to be your natural target? Where are you going to be looking to either exit the trade or at least cover some of your position? Well, as we trade down into this previous support zone, you can anticipate that the demand that was strong enough to reverse this initial decline is still going to be strong and is likely to see price stall at the very least. And vice versa, if you're long from anywhere in this area, your natural target is going to be a move back up into this resistance zone, where you anticipate that supply remains strong enough to reverse any up move. So if you're short heading into support, it's a natural profit taking point. And if you're long heading into resistance, it's a natural profit taking point. And again, this reinforces the supply and demand dynamic, which creates these support and resistance levels. So hopefully by now you're starting to get a clearer picture of what support and resistance are, and that they aren't just lines on a chart, and why they are so useful, or at least how they can be useful. So now we need to focus on how we identify the support and resistance levels. And one key thing to point out at this stage is that you will notice the support and resistance levels on my chart are actually drawn as rectangles, highlighting an area or a band of price instead of a specific price level. And this is really important to understand, because a lot of people, when drawing support and resistance, get caught up trying to be overly specific, e.g. trying to pin price down to a single level, looking to use a single line instead of an area. For example, on this chart, they might place a line starting from the very top of this candle to mark the resistance, and they might place a line along the very low of this candle to give support. And this is far too limited a way to look at these levels. So the way that I generally like to draw them is, for resistance, I will use the candle highs of the resistance level down to the candle close of the resistance level, because you can see that as this candle pushed higher up into this level, sellers stepped in and drove price back down such that the candle closed down off the highs. So we made it as high as this point here, where sellers stepped in and drove price down aggressively so that we closed almost a third of the way off the highs of that candle. So we know that in this whole region here, from the high of the candle to the closing point, there was strong selling, strong enough to take price back down from that level. So the wick of that candle denotes the actual resistance area that we should be looking at, instead of a specific price. Instead of just looking at the close or just looking at the high, we need to consider that whole area as being one of likely supply in the market. Now, again, you can see on the downside that a similar thing happens, okay? We get this sharp sell-off, we're driven all the way down to this low point here, and then buyers step back in and take price back up so that the candle closes midway through its range. So we've pushed all the way down from this aggressive bearish move. And then at this point here, we've seen a sharp reversal and price has closed higher, again denoted by the wick of the candle. So just like with the top side, where the candle high to the candle close gives me my resistance area to look at, well, on the downside, the candle low to the candle close gives me my support area to look at. And it really is important to think of support and resistance in these terms as areas or zones instead of specific lines. And actually you can see, looking at this example, that if we had just stuck to using the very extremes of price, we actually would have missed two of these key reversals. So where price traded up to this point here, if we had only been looking at the very high of this candle as the resistance zone, we would have missed this reversal. And again, to the downside here, if we had only been looking at the very low of this candle, we would have missed this reversal. So again, really studying price and finding these areas of support and resistance can massively upgrade the way that you trade support and resistance levels. It will help you get better trades, and it will also help you stay in trades because your stops won't be too tight, meaning that you'll avoid getting shaken out, as often happens to a lot of new traders when they first start trading support and resistance. They get caught up trying to be too specific with their levels, and they end up getting shaken out on trades whereby their stops are simply too tight. Now, in this example, we have a classic range situation. You can see price is simply rotating between a lower support level and an upper resistance levels. And these scenarios are quite simple to identify. I mean, once you've spent some time looking through the charts, you'll generally be able to get good at identifying these ranging scenarios quite quickly. But let's consider now what is perhaps the most important aspect of support and resistance levels, and which will really help you when it comes to live analysis and trade ideas. And that is understanding the changing nature of these levels. Again, this goes back to the underlying order flow dynamic we discussed, which creates support and resistance. So previously, where we have identified that orders to buy, which we call demand, create support levels, and orders to sell, which we call supply, creates resistance levels. Well, once one of these areas is broken, it reverses its status. So once support is broken and price moves below it, it becomes resistance. And like we see in the example here, once resistance is broken and price moves above it, resistance then becomes support, simply due to the shifting order flow dynamic which is underpinning these levels. So let's take a look at some examples and I'll talk through this more clearly. Okay, so in this scenario, let's imagine that we're roughly at this point in time where we have a really clearly identified support level below us, a really well respected support zone. Price is bouncing off this level multiple times because, as we know, there is strong demand here where buyers are driving price back up. They're stepping in each time that price tests this level and price is driven higher. But then at this point here, we see that after stalling at this support zone and consolidating around for a bit, price actually breaks lower. But then look what happens after we break lower. We see price trading back up and retesting this previous support. And then this area, which now acts as resistance, turns price lower. So why is that? Why is that happening? Well, the reason is simple. Think about why this level breaks and what has to happen in order for this level to break. So we know that we have good demand at this level with buyers holding price up. Price has tested this level multiple times, and each time the buying has been strong enough to take price back up. However, at this point here, we can see that we start to consolidate and then we break lower. So here, buyers are struggling to lift price once again, and then sellers actually overwhelm demand rather at this point. So at this point here where price breaks lower, there are more sellers in the market than there are buyers, and this takes price down. So now once we've broken down beneath this level and we're looking at it from beneath, This broken support, whereby we knew there was strong demand, now becomes resistance, whereby we know that supply at this level must be strong. Okay, we had strong demand at this level to create support. Supply has now outweighed demand in the market. We've broken down through this level, and so instead of looking at this level from above with a view to buyers stepping in, we're now looking at this level from below with a view to sellers stepping in. If we look forward on that same chart to see what happens next, so this is the same band of price that we were just looking at on the last chart. We just zoomed out and looked forward on it. Look how important this one level of price has been to the market. You can see how it's essentially acted as a pivot for price, changing between support and resistance as price rotates higher and lower, and the order flow at this level changes. Okay, so you can see it testing here as support, you can see it testing here as resistance. We break through and then it becomes support once again. So think about the various trading opportunities that would have presented themselves over that period, all based around this one price area. I mean, it's quite amazing, isn't it, to see how well price respects these levels. And the beauty of crafting your ability to identify key support and resistance levels is that they work on all time frames, because the underlying order flow dynamic that creates them is the same regardless of the time frame you're looking at. Now, obviously, the lower down you go, the shorter the term of the level's importance to the market and the less reliable the reaction. But if you start to move out onto higher time frames and identify these key areas, then they're going to be far more important to markets and generally yield a much more consistent reaction. So in this example, we're looking at a 1 hour chart, and you can see just how clear this dynamic is expressed by the movement of price. Let's take a look at this exact same dynamic at play on the higher time frame charts, looking at the weekly charts over several years. So here we have the Aussie yen weekly charts from just before 2007. So again, just as we saw with the 1 hour chart that we just looked at, look how this one band of price is so important to the market over a period of nearly 9 years. You can see that it starts off as strong support here with a number of tests, all rebuffed, all sending price back higher. We then break down lower through this support level. And then, as we know, supply has outweighed demand at this level and support turns into resistance. You can see that we trade back up, test this level a number of times, where each time sellers step in to take price lower. We then break through here. So at this point, we now know, having broken to the upside, that demand is stronger than supply in the market at this level. And once we test it a few times from above, you can see this level acting as strong support. So we start off with this level acting as support, price breaks through, the order flow has shifted at this level, it now becomes resistance. We then break back above, the order flow shifts again, and now price becomes, now the area rather, becomes support. Then finally, once again, we break down and test the level from below, where due to the shifting order flow at this level, we now know that supply is stronger than demand, and we can see the area acting as resistance. So look how the shifting dynamic, the shifting order flow dynamic along this one area of price has been so hugely important, and think about the trading opportunities that it could have offered. So from initially identifying it along these first two touches here, this level has been respected by the markets for 9 further years. So this really highlights the importance and the efficacy of support and resistance in the markets. So we've looked now at what support and resistance is, and we've talked in more detail about the underlying order flow dynamics that create support and resistance. And we've also looked at 2 specific scenarios in which we might use support and resistance. So the first example we looked at, we saw a classic range situation whereby price is simply rotating higher and lower between a upper resistance point where there is supply in the market and a lower demand level, where a lower support level rather, where there is demand in the market. In the second instance, we saw an example of where the support and resistance levels changed their nature. So we had price testing a support level from above, breaking down below, and then retesting from below. And we saw support change into resistance. Okay, so the first example was a range example with price rotating between support and resistance. The second example was what we call a retest of broken support or resistance. In that example, we saw price breaking down through support, testing the level, which then became resistance. Now, if you only practiced these two scenarios, if you got particularly good at highlighting the conditions in the market and developing good trade management and favorable risk reward parameters for these two scenarios, you could be consistently profitable. Support and resistance, trading them just in this manner, formed the cornerstone of the first consistently profitable trading strategies that I've used, and that indeed I still use to this day. And I know many great traders who rely on support and resistance for their trading, from lower time frame traders who scalp up to higher time frame traders, position traders that take trades for weeks at a time. Okay, now these setups might look crystal clear in these examples used, but of course, first of all, they're already highlighted for you, and second of all, and this is key, they won't always look as clear as this. So the key thing is that you need to become really confident in finding these levels for yourselves. So this is key to success in trading support and resistance. You need to become extremely competent at identifying the correct levels, and then you build your trade parameters and your trade ideas out around those levels. So the foundation is simply being able to correctly identify these levels. So let's take a look at a live chart, and I can run through and show you how I plot support and resistance levels. So first of all, when I look to plot support and resistance levels, I like to think of it as looking back in time and imagining that you're seeing the price action unfold ahead of you. So I don't look at the most recent piece of price action and fit lines to that. Instead, I look back at the previous price action where it all starts. So let's take a look at the Aussie dollar, because this is an interesting market at the moment. We've just broken out of the base that we've been in for over a year now. So let's take a run through this, and I can show you how I plot my levels. So we can see that over the last 2 or 3 years, the Aussie has been moving in a fairly sustained bearish trend, where when price is moving lower like this, generally I'm looking to highlight levels that mark a reversal point higher, and then levels that mark the end of that retracement and a return lower. So for example, where price is selling off like this and then reverses higher, this would be the start of a reversal point. And then once price fails and turns lower, that would be the failure point that I would mark as resistance. Obviously in a bullish trend, it would be the other way around. So focusing here on the last 18 months or so, you can see that we're selling off into 2015. But then at the end of this sharp bearish run, you can see that we actually get a clear support level whereby we stall and then reverse higher. So I have a clear support level here to mark. And again, just as we saw in the examples, I don't put in one specific level, I put in a band. So I take the lowest low of these candles here, which mark the bottom of the reversal, up to the close of the candles, which marked that reversal. So this gives me my support level, again, from the low to the close. And then we can see that from this point, we get a short bounce where price trades higher. However, we stall out around this level here, and we turn lower once again. So at this point, I can go ahead and mark in my resistance zone. Once again, I take the candle highs to the candle closes of this area. So now at this point, I have my clear resistance and support levels in the market. And immediately you can see an example of what we were just looking at in the slides, whereby we get price breaking through support. So our clear support level here, we break down through it, We then trade back up and we see support becoming resistance and price trading lower from that level. But ignoring this for now, so assume we're at this point in time, we've marked up our support, we've marked our resistance, price has broken down through this support and we sell off to make new lows. Then once again, we stall and we start to bounce a bit. And you can see here that actually in this area, we get these long wicked candles, which give quite a broad area of support. So we go ahead and mark in the lows of the candles, the close of the candles here, and the low of the candles. But then you can see actually that price pushes down just beyond them and actually forges a new area of support. So initially we'd be looking at this level here, this zone here for support, but price moves through it, and then we can see that we stall and reverse properly from this point here. And so this becomes our clear support level in the market. So we go ahead and mark up our support level now. Again, we take the lows of the candles to the close of the candles. I don't use a specific level, I use a band of price. So this becomes our clear support. This becomes resistance now, we're below it, and we have resistance again overhead. And this is a really important point of identifying support and resistance, which is that you need to constantly update them to make sure that you're using the most relevant area. And so like I just said, again, in this zone here, what looked like support initially, which we would have been marking up with a view to viewing as support, we can see that price actually broke down below, but then we found a new important level which gave a lower base point to price. So price actually found value just below what initially looked like support, and we can see that this zone actually became far more important to price with several tests. And so if we're trading around this point here, we can see this is our clear support in the market, and this again overhead is our resistance point. So we bounce from this level, we trade all the way back up to retest that broken support, which is now resistance, and then we get turned lower from this level. So supply outweighs demand at this level, turns price lower, and we trade down. We retest this support zone, but then we break lower once again and sell off to forge new lows. So we break down through our support, we're trading new lows. So now we look to mark up our next support zone. So the next support zone that we can see is this area here where price stalls out. We get a number of tests to the downside and price starts to retrace higher. So again, we go ahead and mark up our support zone, taking the candle closes of this area down to the candle lows. And this gives us our support zone. We can see that price retraces up to this point. We fail here, and then we turn lower. So I go ahead and mark in initial resistance levels here, okay, assuming we're at this point in time. So ignore the price action, which is after this point in time. We're just focusing on it bit by bit. So I go ahead and mark up my resistance zone here. And then we have price caught in this range for a short period before price breaks lower. So again, we break down through our support zone. We know that supply now outweighs demand at this level. And once again, look what we see. We see price trade lower to make new lows, stall out, and then trade back up to retest that broken support zone, which now becomes resistance and turns price lower. So just like we saw up here initially with price breaking down through support, trading back up and retesting it where broken support becomes resistance, we're seeing the exact same thing down here. We break down through support, we trade back up, broken support becomes resistance, and price is turned lower. So now from this point here, we trade back down and retest these lows where we have another clear support level in the market. So we take the candle close here, which gives us a level back up to these lows. So we can see that price is respecting this level to the downside. We bounce, we trade back up through that resistance. We get above it. We can see that this broken resistance becomes support for a short while. We break back down below it. It acts as resistance and we sell off. We don't make it as far as that clear support level. We turn higher once again, and look how this zone is becoming particularly pivotal to price action. So we had support, a break, resistance, a break, support, a break, resistance, 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 a break again, and then resistance once again. We trade back down, we retest that final support zone at the lows, and you can see that we actually overrun it slightly. We then reverse sharply, trade back up, and again we retest that pivotal zone, that 72.40s to 72.60s zone, which acts as resistance, resistance, and resistance before finally price takes off and we break through. So now at this point here, I'm going to go ahead and adjust my levels. So I'm going to take out this minor resistance level, and I can actually see that there is a much clearer resistance level in the market at this point. So if I take these lines down to this level here, you can see that price reacted off the lows and was capped here, turned lower. We then traded back up again, retested that point, and again we were knocked lower. So this is clearly a very important level to price. And so I'll go ahead and mark that up. Again, I take the candle highs to the candle close. And so, like I say, this really is a process of constantly monitoring the charts and updating your levels. And once you've got good, once you've practiced this a lot, identifying these levels and studied price action, you'll start to become a lot more astute in terms of identifying the levels that are of highest importance to price. So where I started initially with a resistance level here because we capped this retracement, I can actually see that there is a lot of supply in the market at this point to have rebuffed price from this area twice before finally we break higher. And so actually this becomes major resistance and this becomes minor resistance. We can see that two solid tests of this level denote far more importance at this level than at this area here. And so now we're in the current period of price action. And what does that leave us in terms of levels that we need to be monitoring? Well, we can see that we have this clear resistance level above where we have this broken support. And then we can see that we have this clear support level below where we burst through what was initially strong supply in the market. So now we anticipate that at this level here, there is going to be strong demand. And if we break through that level here, then the next level I would be looking at as key support is this level here, this pivotal zone, which we can see price respected so many times from either side of the market. So there are three clear levels to be monitoring right now in the Australian dollar. We have resistance above, we have support below, and support below. So hopefully this gives you a really clear demonstration of just how to identify support and resistance levels and the process you need to follow in terms of updating your levels and adjusting your levels to reflect new movements in price. And this is the process that I follow with my analysis day in and day out. So essentially what I do is consider the previous price action ahead of the most recent price action and then start to map the current price action and adjust my lines as it unfolds. So are there any questions about how I do that just before we move on? How would I draw support and resistance on H1 for the Australian dollar? So actually, a few key tips here. Let me see if this answers your question first of all, and then if not, I can take a look back. So first of all, a few key tips. One, try and stick to the clearest levels, especially whilst you're learning to do this and whilst you're getting the hang of it. If you have to question a level or if you're struggling to find a level, then just ignore it and wait for a clear level to emerge because they always do. And if you do that, it is going to make your life a lot simpler in terms of trading. Okay, you don't want to be cluttering up your charts with hundreds of lines. You want to stick to the most obvious areas and the really clear areas of support and resistance. Then as you build your ability, you can start to add to these areas and build in some minor levels. Now, secondly, I've just gone through a daily chart here, identifying what I see as being the key levels. But as we looked at in the multi-time frame analysis webinar, that we did a couple of weeks ago. There are levels of varying importance on different time frames that we need to adjust for depending on which time frame we trade. So there are probably quite a few areas on this chart now that you might be looking at thinking, why hasn't he drawn a level there, such as, you know, this zone here, and this zone here. And the reason for that is that these are lower time frame levels. So you can see that there is clearly reaction here with price, but these would be levels that I would be marking on my charts if I was on the H4 charts or the H1 charts, okay? So because I'm looking through the daily charts, I just stick to the key daily levels. And really this is more for educational value. It's just to show you the process that I follow when identifying these lines. So I would follow exactly the same process on the lower time frames, where I would have my higher time frame levels marked in, but then also the key short-term levels. But when I'm on the daily charts or the weekly charts, I don't mark in lower time frame levels. But you're exactly right. So there are H1 levels and there are H4 levels. It's simply a question of following this same process on those lower charts. As price approaches a level of prior support and supply, what becomes more relevant of the two? Also considering how price is arriving at that area. So essentially here, if we look at, great Ryan, please answer your question. Okay, Carlos, so if we look at this level here, for example, price has come down into this level, we stalled out, we've seen buyers stepping in several occasions here to take price higher. So we know that demand is strong here to sustain multiple tests of this level. But once price breaks down through this level, we anticipate, well, we know that supply is stronger than demand at this level to outweigh these buyers and take price lower. And so we anticipate that a portion of this supply still remains in the market, either people who didn't get in on the initial move, who weren't able to sell that initial move, and are now looking to sell if price returns to that level, or remaining orders that were unfilled at that level. So for whatever reason, we anticipate that supply still remains at this level. And so as price tests it, we then view this level as resistance. So broken support becomes resistance, and broken resistance becomes support. Now, obviously, it won't always play out like this. You can't guarantee with 100% certainty that every broken support level, when tested, will act as resistance and vice versa. But what we're trying to do is build a picture of analysis that we can use to help us in our trading. And so generally, where we look to stick to these clear areas, we can get some good entries to potential trades. And as you say, considering price as it arrives at that area is also key. So for people who are slightly more conservative in their trading or looking to use extra filters, then using price action is definitely one of the ways that you can do this. So instead of simply leaving a resting order to sell at this point, you might want to identify price action at that level as being indicative of a reversal. So once price trades up into this zone, you might wait for a bearish engulfing bar as a reaction, or you might wait for a pin bar, a hammer candlestick, or you might wait for some sort of reversal pattern. So we might get a mini head and shoulders here. So using price action is definitely one of the ways that you can look to trade support and resistance. Also using indicators, you can encompass indicators such as stochastics or RSI, waiting for them to blow into overbought levels and then reverse back below the threshold to suggest a reversal is likely. Okay, so I hope that answers those questions. As I say, if you have any more questions, please just write them in the chat function and I'll stop as we go along. Okay, so finally, keys with identifying support and resistance. Again, as I said, there is quite a common misconception when it comes to trading support and resistance, and that is that the more times price touches a level, the stronger the level becomes. And actually, as we just discussed then briefly, this is actually false, and the reality is actually the opposite. The more times a level is touched, the weaker it's actually becoming. So if we go back to the slideshow, Okay, so look at this level here, for example. We know that demand is created by a buildup of orders at this level. Now, as price returns to test this level further times, more of these orders are eroded, okay? And this will continue. So either the orders at this point are strong enough to take price up much higher away from this level, or eventually they will be eroded and price will break down. So we get initial orders at this level, which continue to be filled as price comes down. We might get further people stepping in to buy at this level, which keeps the level in play. But then eventually all the orders, all the demand at this level is eroded and absorbed, and price breaks lower as supply overwhelms the market. So this is the dynamic that is in play at these levels. So you can see that the more that price touches this level, the more orders are eroded. So the less so price is testing this level and orders are being eroded. So demand is getting weaker at this level until supply overwhelms, until there are more sellers at this point than there are buyers, and price is taken down lower. So this is key because you want to avoid getting sucked into playing mature levels. A lot of traders, when they're first learning to work with support and resistance, especially in range scenarios, they might be looking at very mature levels because they're easy to identify. There are several touches of the level, and they get sucked into trying to fade the level. So here, for example, after price has touched this zone several times, you don't want to get caught up buying this level only for the level to break on you and to reverse. So don't be fooled into thinking that these levels are getting stronger. Obviously, the initial demand at this level has to be particularly strong to sustain this amount of testing. But what is actually happening is the orders are being eroded, and eventually price will break lower from these points. Now, aside from just reading the naked charts, there are also some tools that we can use to help us identify potential support and resistance levels again. And these are tools that form parts of the strategies used by a lot of successful traders, so they're definitely worth looking at. Just a quick question, Dion. How do we combine trend lines with support and resistance? Okay, yeah, that's a good question. Well, actually, we haven't covered trend lines and channels yet in these sessions, so we'll do that in one of the coming sessions, and I'll look at combining support and resistance with trend lines then, just so I don't confuse anyone who hasn't yet looked at trend lines. So yeah, in a couple of sessions, we'll look at trend lines and channels and how you can incorporate those with support and resistance. So tools that you can use to help you in your support and resistance trading to identify these levels. So tools such as pivot points, moving averages, and Fibonacci. These can all be extremely useful in identifying support and resistance levels. Now, we actually cover all of these levels on the website in the Forex Master course. So I'm not going to go through all of them here because it will take too long, but we'll just take a look at Fibonacci for now to give you an idea of how this works. And actually, the use of Fibonacci in trading is another fundamental element of technical trading. And we'll look at this in more depth in next week's session. But for now, let's take a brief look at how to use fibs, as they're commonly called. So Fibonacci is often referred to as fibs or fib levels in trading. Let's take a look at them and how you can use them in your support and resistance trading. Okay, so looking at this weekly sterling dollar chart, you can see that when we apply a Fibonacci tool, a Fibonacci retracement tool from the summer 2014 highs to those 2015 lows, those initial lows, look at the various retracement points and how they act as resistance when they're tested from below and how they act as support when they're tested from above. So just applying this one Fibonacci tool has given us several areas that we can monitor, and you can see how price is respecting these levels and the sort of reactions we're getting. So if we take a look at this same period on the lower time frames, you can see even clearer just how well these levels work as support and resistance. So this is the same picture using the daily time frame. So we were just looking at the weekly period. Now we're looking at that same period on the daily time frames. And remember, these levels were drawn in before price was there. So let's assume we're at this point here. We've just rallied up off this low. We simply take our fib retracement tool, apply it from the high to the low, and then the tool automatically plots these lines on the chart, which we can then monitor as support and resistance. And look how many times price respects these areas and uses them. So we can see that initially we rally up here and we trade all the way up into the 50% retracement, where you can see we get a sharp reversal. But before that, look at the support that comes in here. We break above the 23.6 area, we trade back down, use that as support. Again, we see it as support here. We see it as support further times here. We can see that once we've broken back below the 38.2% retracement, we trade back up and it acts as resistance. So there are several areas here where price has found support and resistance simply at the Fibonacci retracement levels. Now, although these levels can be powerful support and resistance areas alone, looking away from structural resistance, where they actually line up with structural support and resistance, these levels become even more powerful. So if we look at this point here, you can see where the 50% retracement lines up with these previous lows, so this previous broken support. Look how powerful that level can be. Again, here we can see that a test above of this level, where it lines up with this broken high, offers great support. So looking to combine structural support and resistance, such as we've been looking at on just reading naked price action, combining that with technical support and resistance, such as Fibonacci levels, can be a really great way to identify these areas. As I say, we'll look at Fibonacci in greater detail in next week's session. Okay, so that's it for this week, guys. Are there any more questions I can answer before I go? Okay, great. Well, hopefully by now you can see just how important it is to develop a solid understanding of support and resistance, and just how useful these levels can be to you in your trading. And we've gone way beyond the idea of support and resistance as just being lines on a chart, and we discussed their deeper relevance in terms of order flow. And again, as with all aspects of technical analysis, it really does boil down to how you personally are able to use them as a trader, and whether you find them effective tools in your trading. I mean, I personally use support and resistance as the cornerstone of my trading, and developing a proper understanding of these levels and their uses was a huge turning point for me in my trading. And the great thing is that these levels can fit into all number of different strategies. We've talked briefly there about scalping methods, higher time frame methods, combining other indicators into your trading, or just using naked price action alone. We've also looked at some tools you can use to identify support and resistance away from just reading the charts. And if you want to learn more about any of these tools, then I strongly suggest you check out the website www.littlefishfx.com and look at a whole host of free material on there. We've got the Forex Master Course also, which covers all of these technical aspects in great depth with some really valuable trading ideas and trading strategies. And if you're keen to discuss trading ideas in general, market analysis, then definitely check out the live trading room on the website, where you can interact with myself and the other LFX traders who are active on a daily basis. Okay, so thanks a lot for joining me this week. I hope you enjoyed that session and found it useful, and I look forward to talking with you all next time. Thanks a lot.